Welcome back. We will be covering chapter 3 this week, which is analyzing business transactions using T accounts. In the past two chapters, we have covered a few objectives in this course. Our first objective was to identify activities and users associated with accounting. We learned that this consisted of three activities, which include identifying an economic event, then recording the event, and the final step was to communicate the event. We learned that there are internal and external users that are interested in the accounting process of a business. Remember that the internal users are managers and CEOs, and the external users are investors and creditors. The second objective is to be able to explain the building blocks of accounting, ethics, principles, and assumptions. We learned about cases like Enron, which resulted in the Sarbanes-Oxley Act, and about the generally accepted accounting principles that are required for accountants to follow and in order to report financial statements in a uniform manner. We also learned about the Financial Accounting Standards Board and the Securities and Exchange Commission, as well as the assumptions that all accounting records or transactions involve money, so there are a monetary value. We just learned in the previous chapter about the accounting equation. We learned the basic accounting equation as well as the expanded accounting equation, and you had the opportunity to work with these equations in order to identify accounting transactions, and you had the opportunity to record them in what we call tabular form. This is what the tabular form looks like. You had the opportunity to review some transactions and record them in the appropriate account within the expanded accounting equation. And you learned that each account must be added in order to determine the balance of each account. You can see the balance of each account in the color red. And finally, you had to make sure that the accounting equation was balanced, which can be shown in the color blue. Our fifth learning objective is to describe the four financial statements. This was briefly covered in chapter 2. However, I did not cover it during last week in order for you to have a chance to focus your attention to recording transactions in tabular form. Chapter 2 covers three financial statements. There's actually four of them, which include the income statement, owner's equity statement, the balance sheet, and the statement of cash flows. This is an example of the four statements from a previous book that I used when I taught this course in previous semesters. I like this visual because it shows you how different information within each financial statement relates to other parts of the financial statement. You can see that by the arrows. So let's go through it step by step. The first step is the income statement. The income statement covers information about the revenues and the expenses of a business for a particular period. In this case, is for the month of September. The goal of this statement is to inform internal or external users about the net profit or net loss of a business at a certain period. The internal or external users want to know if the business made money or lost money for a particular month. So you start by recording the balance of the revenue account and then record the balance of each expense account. Remember that a business can have several accounts within the accounting equation. In this sample, there are expenses for salaries and wages, rent expense, advertising expenses, and utility expenses. So it's recommended that you keep your expenses separated by categories in order for you to know the expenses for different categories. I know that in the previous chapter we lumped all of the expenses under the expense account, but you can certainly create an expense account for different categories to separate the amounts and in order for you to exactly know how much you spend on certain things. Once you record the revenues and the expenses, you determine if your business has a net profit or a net loss by subtracting the expenses from the revenues. If your result is a positive number, then your business has a net income for the month. And if the balance is negative, then your business has a net loss. And we will record that here as net loss. In this example, the business has a net income, and it's a net income of $2,750 for the month of September. Once you complete the income statement, the next step is to record the owner's equity statement. The purpose of this statement is to report the changes that occurred in the owner's financial interest during a specific period of time. In this case, it's also for the month of September. We know that the business had a net income for the month of September, but how does this impact the overall financial interest of the owner? So remember that the owner's equity consists of owner's capital, owner's drawings, revenues, and expenses. Remember, this is part of the expanded accounting equation. So what we do here is we start this statement by recording the balance of owner's capital at the beginning of the month. In this case, it's September 1st. This statement, this sample here, shows that there was a balance of 0 on September 1st. But if there was actually a balance, then you will record it here. Then you add investments. In this case, it's $15,000. And then you add any net income or net loss. And you do that by bringing down the balance from your income statement. So from our income statement, we recorded the net income as $2,750. So we take that balance and record it under the net income under the owner's equity statement. If during that month you had a net loss, you will record it here as well in the same space, but you will record it as net loss instead of net income. Then we add the balance. In this case, it's $17,750 since we started with 0, but we had investments and a net income, which total $17,750. And then we deduct any owner's drawings that happened during the month. In this case, the owner withdrew $1,300. So our balance for owner's capital at the end of September is $16,450. Once the owner's equity statement is complete, we can move forward and complete the balance sheet. What I'm going to do is exit out of this PowerPoint in order for me to move this visual a little higher since it's longer than what the slide can fit. So here's the balance sheet. The goal of the balance sheet is to show that the accounting equation is balanced. So we show the account balances for assets, and for liabilities and owner's equity. We start with assets, so we record the balances for cash, accounts receivable, supplies, and equipment, and then we find the overall balance. In this case, $18,050. Then we move on to liabilities and owner's equity. We record any accounts under liabilities. In this case, it's accounts payable. And then we bring down the balance for owner's capital, which was determined under the owner's equity statement. We find the balance from liabilities and owner's equity right here. In this case, it's $18,050. And we compare it with the balance on assets. Now, the two balances or the values must be the same. Otherwise, that will tell you that there's an error and we need to fix it. So notice that the balance sheet is not for a period of time, but for a specific date. In this case, September 30th, 2017. This is the only statement, the balance sheet is the only statement that is not for a period of time. It's for a specific day. Okay? Now let me exit again so I can move this visual up higher. I think that will be enough. Now the last statement is the statement of cash flows. Remember that this is not covered in chapter 2, but I wanted to share this with you as well as since you will eventually have to deal with this statement. So I'll show it to you now. This statement shows how much cash is coming in and out of the business for a particular period. In this case, for the month of September. You want to report how much cash comes in from sales, how much it comes out when you pay expenses or when you purchase equipment, and how much money comes in when the owner invests in the business or how much money comes out of the business when the owner withdraws from the business. And so the ending balance should match your balance in the cash account. Notice here, cash account is $8,050 for the cash account, and after you complete the statement of cash flows, it also matches $8,050. So now that you know how to record transactions in tabular form and you know how the information is transferred into the 4 financial statements, we can now move forward with the next concept, which are T accounts. This is just a different way to record the transactions that we covered in the last chapter. An account is an individual accounting record of increase or decrease in a specific asset, liability, or owner's equity item. And the T account has 3 parts. It has a title, and it has the left side known as debit, and the right side known as the credit side. Now many, including myself when I was going through the master's program, I got really confused with the concept of debit and credit. Many get the concept confused because when we think of debits or credits, we tend to think that debit is deducting or decreasing and that credit is adding or increasing. So let's think of our bank accounts. When we hear debit, we think that money is taken out of the account because we paid for a bill or we purchased an item. And then when we hear credit, we think that we got money returned to our account. I want you to erase this from your memory and not think that debit is decreasing and credit is increasing. If you think of debit and credit in this manner, what will happen is that you will get confused and you will not get the homework assignments completed correctly. So all I want you to learn and remember at this point is that debit is the left side and credit is the right side. That's it. Don't remember anything else. Debit is the left side, credit is the right side. Now, this visual will become your best friend as well. Your first best friend was the accounting equation. And I asked you to make sure you keep that close to you so you know, you memorize it or you keep it close so that you know how to complete your homework assignments. Now you have a second best friend, and this is it. This is the visual. This is a visual that is not on your textbook again. I got this visual from a previous textbook that I used to teach previous courses, but I like it, so I suggest that you also print this and keep it close to you when you're completing your homework assignments. This visual will tell you if a debit increases or decreases an account, or if a credit increases or decreases the account. Now you will see why I need you to just remember that debit is left and credit is right. As you can see here, there's no pattern. There's no pattern to indicate that a debit is decreasing and a credit is increasing. You see that a debit can either increase or decrease. And that will depend on the account that you're dealing with. So to avoid any confusion, please use this visual to determine if you need to increase or decrease a debit, or the same thing if you need to increase or decrease a credit. Okay? You will determine which account is affected by a transaction. You learned how to do that in the last chapter. And then you will determine if it needs to be recorded as a debit or as a credit on the correct T account. Notice that this visual represents the form of T accounts for the assets, for the liabilities, for owner's capital, owner's drawings, revenues, and expenses. They're in the form of T accounts. And remember that T accounts consist of three parts: the account name and the debit and credit side. Debit and credit side. Okay? Okay, let's move on. So here's an example of what you learned in the last chapter and what you will learn in this chapter. In the last chapter, you learned to record transactions in many accounts within the accounting equation, and that was recorded in tabular form. Here's we have an example of the cash account in tabular form. Depending on the transaction that you were dealing with, you recorded the amount as a positive or a negative, and then we found the balance of the account and recorded that at the very end. So you can see we have positive 15,000, which was deposited. Then we took out 7,000, perhaps to pay for something, and so on and so on, and then we determined the balance to be 8,050. Okay? Now, what you will do in this chapter is you're going to record similar transactions, but now you're going to do it in the in the accounting form, or the T account. The difference is that we separate the transactions as debits and credits. If you refer back to your best friend here at the top, when we deal with assets, we record positive numbers under debits and we record negative numbers under credit. So we record positive numbers under debit, or the left side, and we record negative numbers under credit or the right side. So what this tabular form tells you is that you started with $15,000, and in the accounting form you will record it as a debit, because if you look at your best friend here, in order to increase the asset account, you need to record it under the debit side or the left side. Okay, then probably the next transaction is that we paid for something that we purchased and the amount was $7,000. So that is decreasing our cash account this time. So we record it as a credit or on the right side, because that's what asset T accounts does. If you need to decrease the asset account, you record it as a credit. Once we finish recording our transactions, we need to determine the balance, which is what we did in the tabular form. We determined the balance. Okay? So what you need to do is you need to add all of the debit numbers and then add all of the credit numbers. And then you need to determine the difference between the two sides. Whichever side is larger, that's where you will record the balance on that side, on the side that's big and that's larger. Now, on your textbook on page 60, it tells you that if the total on the right side is larger than the total on the left side, then the balance is recorded on the right side. That's not what's happening here. What's happening is that the left side is larger, so the balance is recorded on the left side. Okay? Now, if the account only shows one amount, then that amount is the balance and it'll be on the particular side that you show that balance for. Okay? All right, let's move on. So what I'm going to do here to help you see the relationship of this new method, I am covering the same example that was covered in chapter 2. The first transaction consisted of investing $30,000 in a restaurant. And what you did is you recorded this transaction in tabular form by asking some questions, which included determining the account that was affected within the accounting equation. And when you asked those questions, you determined that the cash account and the owner's equity account was affected. So you recorded this transaction by increasing the cash account and the owner's equity account by $30,000. And then you determined the balance on each account and you called it a day, which is showed here in red, 30,000. You saw that the equation was balanced and you were done. Now, what you will do is record it in the T account, which is on the bottom here. You will have a T account for cash and another one for owner's capital. But this time, you will refer to your best friend here, your best friend number 2, and determine if you will record it as a debit or as a credit. Depending on that answer, you will know if you are increasing or decreasing the account. So for this example, you know that you are investing $30,000 in cash. So you know that this is an asset. Okay? So if you look at the asset T account, you increase this account by debiting the account. Okay? Or the left side. You ask yourself the same questions again for owner's capital. You look at the T accounts for owner's capital, okay, and determine if you will debit or credit the account. Well, as an investment, you know that this transaction is increasing the account, the owner's equity account. So in order to increase owner's equity, you need to credit. You need to record it as a credit or on the right side, which is what we did here. Okay? Notice as well that we need to record the transaction date. You'll probably in your homework will give you a transaction date. That's what this means here. It means that on April 1st, the owner invested $30,000 in cash. This increases the account under assets, so you record it as a debit. There's nothing else for you to record, so you find the account balance. In this case, is $30,000, and you record it on the debit side as well. Same thing for capital, and this was actually, the balance was like at the end of the month. Owner's capital is the same. On April 1st, it was invested $30,000, and in order to increase the account under owner's capital, you record it as a credit. So you put it on the right-hand side as $30,000, and then you find the account balance on April 30th for $30,000, and you're done. Okay? This is transaction number 2, which was also from last chapter. For transaction number 2, the owner buys equipment for $10,000 and pays it in cash. So from the last chapter, you determined that the cash and the equipment account is affected. They are both assets, so you look at the T accounts for assets. In this case, you will have a new T account and label it equipment. And you will increase this account because you are adding equipment to your business. So in order to add or increase the assets account, you record it as a debit or on the right side. So on April 2nd, we recorded equipment for $10,000 as a debit or on the left side. For the cash account, you are decreasing the account because you have to pay for the equipment in cash. So if you notice on your assets account, in order to decrease an asset account, you have to record it as a credit. Okay? So you do this by crediting the account by $10,000 or record it on the right side. Notice that I still have the previous recording transaction, which is for the investment of $30,000 into the business. You don't start a new one. You continue with the recording process. And then you will determine the balance of each of the T accounts by adding each side, the debits and the credits, and recording the account balance on the side that is the largest or the biggest one. So in this case, $30,000 we have in debits and $10,000 we have in credits. So subtracting those two amounts is $20,000, and it's a positive $20,000. So we keep the account balance on the debit side. We bring down the balance for equipment, and we bring down the balance for owner's capital. Notice that I also kept the owner's capital T account. So you will continue this process and record all transactions in the appropriate T accounts by following this chart here. And you will determine if it's recorded as a debit or a credit, depending if the transaction is increasing or decreasing and depending on which account. Okay? Once you do that, the last objective for this chapter is to complete a trial balance. And all that you do here is record each account that you were dealing with during the transaction process, the transaction recording process, and you record the account and the balance of each of those accounts in the debit or credit side. So if your balance is on the debit side, remember the last here, the balance is on the debit side for cash for $20,000. So you will record this on the trial balance as cash on the debit side for $20,000. Okay. For equipment, the balance was on the debit side for $10,000. So you record it as equipment and then under the debit side for $10,000. And likewise, if your balance is on the credit side, in this case owner's capital is on the credit side, then you record that balance on the credit side, and you do that by labeling it as owner's capital and on the credit side for $30,000. And then what you do is you add the overall balance for each of the debit side and the credit side and make sure that the amounts are equal. Okay? If they are not equal, then you made a mistake somewhere. And so the trial balance will alert you if you made a mistake, and it will alert you to go back and find out what's wrong and fix it. Okay, and that is it for this chapter. Your assignments for this week is to read chapter 3 and complete your homework assignment. So please contact me if you have any questions. And thanks again for your valuable time.